Andrew, you were saying a moment ago that markets can look ahead to the rate of change. And so many people have been saying to me the reason that equity markets are priced where they are is that people are looking through not just the economic data, but also earnings to the recovery on the other side and, importantly, to the stimulus on the other side. Does what you're seeing in investor positioning, sentiment, levels of cash support that view as well?
Yeah, it's interesting actually, because while I hear a lot that I think from investors that the market as we say is kind of expecting a V-shaped recovery or is expecting things to normalize. Actually, I think talking to investors, I think there's a lot of skepticism. I think a lot of investors themselves are more hesitant about that view and are more skeptical that growth will bounce back. And so I do think investors are reasonably cautious here. We see that in many different measures of positioning. We see that high cash balances, as you mentioned, where I think a lot of investors, for very understandable reasons, in March and April, sold assets, tried to get more liquid in what they were holding, but that has left them with unusually high levels of cash, which ultimately I think helps limit some of the downside in the market, and over the longer term, I think should be a supportive factor.
If that cautiousness among investors shifts and we see some of the cash start to come off the sidelines, Andrew, what's going to benefit more, equities or credit?
I think at the moment credit will, and I think there are a couple of reasons for that. I think corporate management teams, I think, have moved into a credit-friendly mindset. They're focused on protecting the balance sheet more than growth, which is a phase in the cycle that's often quite credit-friendly. I think with credit, you have less uncertainty, or you're less vulnerable to exactly where earnings end up, or Tom, as you kind of mentioned at the opening, some of these discussions around, say, where the tax rate might ultimately end up after all of this. Credit will be somewhat less sensitive to that. So I think for the moment, both investment grade and high yield credit are the bigger beneficiaries. But look, ultimately, I do think this will filter into equities as well, and ultimately. Yeah. I think that's especially true if we start to see more clear signs that the data really is bottoming.